And welcome back to WealthWise. It's Jordan Kimmel, your host. And as we've always promised, we're going to bring on a couple of great guests. And before I bring them on, and these are names that you'll know and you've seen, and women that are really, on TV all the time. But what I always want to do is set the stage for what I'm seeing and what I'm thinking for just a couple minutes for Magnet Insights. And we're also, by the way, following this up with a weekly note. And we could we can help you in many different ways, a lot of different avenues we're working. But the main thing I want to share with you is that people will look at the indexes, people will look at the economic news, they'll do whatever they want to try to pick what is driving the market. What we're doing instead is we're looking at advanced decline lines. We're looking at new highs and new lows to see what the health of the market is. Even the greatest stock pickers, the greatest stocks, something like 60 to 70% of companies will actually follow the indexes. So you need to know what the trend is. Is it healthy? If the market is truly unhealthy, you don't want to even have exposure. You want to be in the clubhouse, so to speak. But when the sun comes out and the course is there, then you actually have to have your game. And I think our strength is the magnet stock selection process. Our stock picking is what we think about all the time. But it's also you have to look at the environment. And what I'll share with you is that the environment actually is starting to change where the new lows are actually creeping up a little bit. The advanced decline line is actually not as healthy on NASDAQ as you think it would be. We're even seeing more new lows on the NASDAQ than we're seeing new highs. So it's a couple of companies. We know what they are. We don't have to talk about everyone's favorite stock on every show. But what I'm sharing is the environment is healthy with clouds looming. Okay. And we are nearly fully invested in this weekly report we've shared. A couple of the ideas already been dynamic, and we're excited to share, in that venue too. But let's just call the field healthy. Let's call the atmosphere conducive to stock pickers. And with that, we're going to take a real quick break. We're going to bring on a friend, Nancy Zambell from the Financial Freedom magazine. And Nancy, I know Nancy for a while. She'll bring some great insight into the markets themselves. And later on, we'll bring on Erin Gibbs. And you all know Erin Gibbs from Fox, Main Street Asset Management. We're going to bring on different perspectives. We always said we would. It's not a matter of what I think, it's a matter of different views, different insights. We'll be right back with WealthWise right after this quick break.
We give game day a whole new meaning.
And welcome back to WealthWise. It's me, your host, Jordan Kimmel. And I wanted to bring on Nancy Zambell. It's an old friend of mine. We'll get into how we met and who she is in 1 second. Nancy, thanks so much for joining us.
You're welcome. Thanks for having me.
Well, Nancy, just a few years ago, we met on AAII. You were a powerful voice there. I knew that not only did you have a country accent, you had some country wisdom. And before we really get into the markets themselves, you're always involved in some, kind of a longer term, investing projects and processes. Share exactly what you're doing, and then we'll get into the market itself.
Okay. Well, a couple of very different things. One, I have been with the Cabot Heritage or Cabot Wealth Organization for over 10 years now, writing a bunch of different newsletters. Today, I write Cabot Stock of the Month, which is kind of a compilation of picks from various analysts within the Cabot organization. And I usually focus on one analyst and one stock every month. And we build up a portfolio of stocks as well as ETFs. So that comes out monthly. And then I was always interested in personal finance, which you may remember, Jordan. And
Yeah.
I get asked so many crazy questions when I'm presenting that, people who are 55 years old that haven't saved 10 cents for retirement. And I thought that, that needed a voice. And so we created this magazine, I think about 3 or 4 years ago. And I tackle everything from estate planning to when to take your Social Security. The one I just did was on student finances. What do the graduates need to do today? And the third thing that I do is I own a real estate company. And I don't know if you were aware of that or not. But I've had a real estate company for about 5 years now, and I've been in that business for over 20 years. And so it's kind of interesting to juggle both.
Well, a couple different asset classes coming into play, and they're all foundations of long-term wealth. So, not surprised we're in real estate. And I'm going to follow that up another time when we have a little extra time, because one of the projects we're doing right now involves, real estate, and we're looking for an expert in the field. And I have a feeling you might fit that bill. But you know, what I want to, say, Nancy, is again, back in the old days of the individual investor, American Association of Individual Investors, you're pretty prominent there, and you held a message on a style of investing. I know that there's an old adage saying something like, butcher it a little bit, but something like in the long run, the market's a weighing machine. In the short run, it's a voting machine. Whether that's Warren Buffett or his tutor, I'm not sure. But whole thing I'm bringing out is AAII was known for its sentiment gauge, and you really, I think, take to heart market sentiment and what happens with valuations, whether the market's optimistic or not.
Yeah, yeah. And the sentiment today, as you probably know, is pretty bullish. It's actually increased in the last month. Individual investors, which is always worrisome to me and probably to you too, when they get very bullish, it's like, I'm selling everything. But they're not at that point yet. And of course, the professionals, they're bullish too. The greed index that CNBC has is pretty much neutral at the moment. But everything looks pretty bullish. And I do follow that. Although, as you know, I am more of a long-term investor and a value investor with growth. When
Right.
I started out right out of college, my first job as a securities analyst, like, oh, I'm going to be a fundamental value investor forever. And of course, that lasted about a year.
What happened, Nancy? You saw a chart?
Yeah, I saw a chart and I learned a little bit about technical investing, which I am no expert on, but it was really eye-opening to look at the market as an adult, and people get so wrapped up in the moment to moment. And you and I both know that it stretches over decades. I mean, we should be looking at our portfolio over decades. That doesn't mean we can't trade some really hot stocks once in a while and,
Right.
make a killing on them. Like Peter Lynch used to say, the 10 banger. But I've always been more in the alley of Warren Buffett and looking fundamentally at strong stocks and then trying to decide when to buy and when to sell them.
Right. Well, that's the foundation of a lot. And frankly, when people begin to trade only off moving averages and crossovers and options gamma, and when that begins to happen, valuation goes out the window. And that's when I think a lot of experience comes into place. And I'm not going to say you've been to more than three rodeos, but this is not your first.
Yeah.
And having a little experience and wisdom and thinking long term, goes a whole lot of ways. So, what I wanted to do is I'm going to bring you back to talk real estate specifically. But is there anything, right now, maybe sector rotation wise, or anything that you're looking around the corner, so to speak, and tactical moves that you'd be making right now?
Yeah, I mean, I just sold some ETFs out of our portfolio. I had one, I can't remember which one it was now, but it was communication services. And that had done really, really well for us. And of course, that's the best sector so far this year, up over 14%. But I sold out of it, maybe probably a little bit early. But I'm still really in the growth sector. I'm still a believer in technology. I'm happy that the financials have started coming back. And I think as long as the economy continues strengthening, that we'll see some good deals in the financial side of things. But I've always been more of a believer in that regional bank stock rather than the
Mhm.
super banks, because I don't know if you remember, but I came from a banking background, and
Okay.
I saw every bank I worked for got bought by
Acquired.
another bank.
They're all acquired. Yeah,
Yeah,
it's
yeah,
funny, and so it's something you can count on down the road. But so let me just say, I'm a city boy, but I love the country wisdom. And Will Rogers probably got it more right than anybody else. He said, all stocks are bad. I only buy the ones that go up.
yeah.
Right? And
Me
when
too.
they stop going up, I sell them. Right.
Yeah.
So he was a momentum investor before the rest of us. But Nancy, it's so great to see you. I'm glad continued success for you. We're going to bring you on to talk some real estate real soon. And thanks for your time today.
Well, thank you. Appreciate it.
All righty. It's Jordan Kimmel. We'll be right back with more WealthWise right after this.
Like the Kentucky Derby, Woodford Reserve Bourbon is a spectacle for the senses.
And welcome to WealthWise. It's Jordan Kimmel, your host, Jordan Kimmel. And here's a face you see quite a bit on Fox and all around the media. It's Erin Gibbs. She's the Chief Investment Officer over at Main Street Asset Management. We see you everywhere, Erin. Congratulations on what's going on. Thanks for joining us today.
No, thanks for being here. I'm happy to be here.
Right. So we've never crossed paths, by the way, at Fox. I'm there myself a lot. I looked up your background because, we don't know each other. I know we have a bunch of common friends, and I know you have a big quantitative background. And I remember in New York City, there used to be something called Quaff a Few,
Yep.
right? And it's changed its name, but I know you know that crowd. Why don't you share, if you can, if you like, a little bit of the role at like Main Street Asset Management, what you guys actually do and how you help them.
Sure. So we have basically multiple tactical products. Most of the investments are ETF model based, but they can take individual stocks or individual positions, particularly if we're looking at trying to use some type of derivative trade. We do have that option because they are all ultimately all the models can be individually tailored. And so we look at different risk profiles. So we have 6 base models that are tactical allocation models based off of your risk profile. And then also, of course, everybody has their own cash needs. And so we can adjust those, also, of course, customize and tailor to any holdings that you bring in that you don't want to necessarily realize the gains for. And so we can work around and model for adjusting for those holdings as well and setting your risk asset management. The reason why I joined Main Street is that I do have a quantitative background. I'm very good at adding that quantitative discipline. So taking a lot of the emotion out of the investment decision process and putting that strong quantitative discipline in there, doing a lot of robust back testing, really understanding how the markets react to certain both macroeconomic effects as well as earnings effects, and looking at that from a lot of different standpoints. We also have a stock selection model where we choose the 50 most attractive stocks across US large cap and small and mid caps to create an optimal portfolio to give you exposure to the US large cap and SMID, small and mid cap range. And so a lot of the stock picks that you'll see me mention on TV come from that quantitative stock selection model. So I'm a heavy believer in trying to minimize the emotions. I've been in this business for over 25 years, and it is tough. It is very tough. And there are many days where you look at your screens and your stomach just turns in many, many knots. And so I find the way to help me get through that and to stick to ultimately your long-term path is to use these types of quantitative models as your base investments theory and your base investment discipline so that you don't go off the rails too much.
Right. Well, you're saying a lot there, and I love what you're saying because, again, my background too is quantitative and more, completely bottoms up, and looking for exceptional stocks. If you would have told me 30 years ago that nobody would care anymore and that they really just cared about ETFs and allocating it to ETFs, you would have broken my heart then. But someone should have told me 30 years ago how the business would change. But what you're also saying, Erin, is know what you own, and when you know the valuation or your models give you an indication, it's going to help you a whole lot, especially when the market's going against you. We don't learn a lot of lessons on the way up, do we?
No, you really don't. Certainly there's FOMO of, I wish I had invested earlier. I wish I'd gotten over my fear and gotten back in the markets a little earlier. I know there was a lot of that in 21 and 22, but there's just a lot of lessons to be learned of being able to really stick to your discipline and also really understanding your risk tolerance. And I think that's what a lot of clients have learned over the past few years, is really understanding just how much risk they're willing to take. And part of it is just not looking at your portfolio every single day. There's nothing wrong with looking at your quarterly results and saying, am I still sticking to my risk profile, or what in my life has changed versus am I just a little uncomfortable right now?
Right. Where, Erin, did those clients go, in the world of sped up information? But you know what? I want to bring out something. This is very serious because I was talking to someone who recently, there was a death in the family. There was a whole lot of money to invest. And the question came in is, are asset managers worth their fee? And the point is that even if you're not using sophisticated models, what they'll help you to do is not sell at the wrong time. The individual will panic when they see their account down and want to sell at the bottom. They'll get enthusiastic. They'll want a margin at the top. You know this.
Yes.
So the whole idea is the behavioral side, which you're discussing. To me, is incredibly important. What I want to get back to, two things, just because I love the fact you've just got this quantitative background. And I'd love to I haven't seen them yet. I'll share our best ideas. I'd love to see, frankly, your list of top 50 stocks. But the question I have here is that it's the big debate. It's the hardest question I know. Okay, so there is no answer to this. One thing's about trend following, and the trend is the trend until the end. And then you maybe hear chaos at the top, and you could feel a signal changing. But the question is that if your model says buy, and the stock itself keeps going lower, do propose to cut your losses, maybe the model was wrong, or to average down along the way?
Right. So one thing is, so part of the discipline is we rebalance quarterly. So, and rebalancing quarterly, part of that is getting more fundamental and macro data coming in, as well as the technical. So the price action. And so it's a combination of using the price action. If something's telling you, look, something's just wrong with the stock, the market doesn't like the stock, as well as the combination of the fundamentals of saying this company is doing really well, they're forecasted doing well, the analysts think it's going to do well in the future, and where's that disconnect? And so again, we invest, the model picks 50 stocks, so it's diversified. It's not going to be 100% perfect. There are going to be a few duds at all times. There's always going to be a couple duds. Ideally, you do want that 51% that gets you ahead of the pack. So I think one thing, no, if there are a couple stocks that aren't performing, I think that's just part of being a portfolio manager. You can't get 100% right and beat yourself up about those two stocks. ultimately that's 4 or 5% of the portfolio. Let's focus and make sure that the entire portfolio. So I look at more systematic issues of, wow, why are 60% of my stocks not seeming to follow my expectations? I'm not achieving the alpha. Is there something in the model that I'm missing? Is there some new value that investors are looking at that I haven't updated my model? So as a quantitative researcher, it's more about understanding broad investor behavior and saying, am I picking out every single possible thing that I can think about that's important to investors right now? And then how often should we update what data we're putting in for that selection? Are we missing a component? Should we take one out? And so that's sort of the constant research that you're doing, is how can we predict what investors are doing? How can we predict what's important to them? And should we be too trendy? And this is what investors are looking at this week, and they're going to change their mind in 2 quarters. What has been proven over decades. Unfortunately, we have a relationship with S&P Global. We use a lot of their data, so we have many decades of data to be able to do some of these back tests and test some of our research. And so I wouldn't say, like I said, a couple stocks don't keep me up at night. It's really about looking at the overall performance and understanding your entire portfolio.
Well, that's a whole lot of experience, and I think you hit it really right on the head. And it's not a mistake when a stock goes down. If it was a mistake, we'd have a model that's perfect, and none of us do. And the whole idea is to put probability on your side and keep the reinforcement, or keep calibrating without a big ego. And it sounds like to me, Main Street Asset Management, I'm lucky with Erin Gibbs.
I would like to add one thing that lesson that I learned very early on in my career when I worked at Bernstein is, and they're a big value buy. They have a quantitative for their money management side. I was on the buy side, so started doing quantitative investing very early on. And one thing they really wanted to instill in us as analysts is that, particularly when you're looking at value, it's very hard to time the bottom. And frequently, you're better off getting in a little early where the stock still goes down. So it hasn't quite hit that turn in momentum. It's okay if you get in a little earlier, because you're going to make the money on the upside. And so, if your stock is underperforming, let's say for the first quarter that you get into it, even the second quarter, that isn't necessarily, if the fundamentals are there and the fundamentals are still saying this is a great company. For me, I've seen it so many times that that's not a reason that I'm going to dump the stock or really be concerned about it. It's, so when you get in that third or fourth quarter and it's like, okay, clearly the market's saying something that disagrees with the fundamentals, and I need to listen, type of thing. But I've just seen it so many times that frequently, our biggest losers for, let's say, Q1 or Q2, often turned out to be our absolute biggest winners for the next 18 months. And I saw that. I remember we got into Hewlett Packard when, absolutely all sentiment was against it. It was just the most beaten up stock, and it was a triple overweight in one of our models at S&P. And when I saw that it got this triple overweight, like my stomach just did flip flops. I reran the model 3 times. Like, why is it telling us that it was in the headlines of the Wall Street Journal every day, because it was just valued as like the worst company on earth, and ultimately it was our biggest winner the next year. So you have to have a lot of strength, and I think relying on the numbers are really much more reasonable than relying on headlines.
No, great story. I'm glad you shared that. And people, Erin, might even say it's been the second and third year of owning something where the results came. And so real value investors do their homework. And the concept of, I bought something, my confirmation printed, it should be flying by now, are people that really need some humility and some experience. And I really want to say it's a great discussion today. I am very interested in seeing your list, knowing they're quantitatively drawn, and we'll hope to have you on periodically and share your best ideas with us as well.
No, thank you. Thank you very much. Happy
All right, so let's wrap it up. It's Jordan Kimmel, it's Erin Gibbs from Main Street Asset Management. Great discussion. We'll see you soon on WealthWise again.